This is it. We are now we are now live. We are now live and we're waiting for the Fed. We're looking for the Fed to tell us exactly what they think is going to happen to the economy. And more importantly, what they're going to be doing to the rates. Okay? So here we go. We are live. Okay, so we're basically waiting. We're waiting any minutes for the news. We're waiting for decisions. Nothing yet. And then at 2:30, what's going to happen is we're going to hear it from the Fed themselves. Now, what is significant right now is that even if you have the rate decrease, which we expected, what we're going to be wanted to listen to, what we're going to want to hear from the Fed chairman, exactly what is it that he wants to say? What is it that he's going to be talking about? How is he going to be sounding for the next one? Because now they're concerned that maybe we should not be doing any more decreases. And see how our portfolio is going to react of the news. As you could see right now, we are basically in the red, but we've been the red and the green and the red and the green. That tells me that the market is a bit nervous, okay, as to what he's going to say. So we have to be careful. If you have some gains, which we do, let me show you what we have, where we are, where we stand right now. All right, what did I do? Well, we all, it's all red right now. Unfortunately, let me play around with this. But basically, we did put an interesting trade on. I did put an interesting trade this morning on VMC. Why? See VMC at the bottom here? Well, that's interesting because this is a play on the infrastructure, and so far we have 5% in one day. That's not too bad. No, we're getting killed a little bit on all the others right now. There's some uncertainties on SPY, Tesla, and the two Teslas. Now, this is a big disappointment, GCT, but it's a stock price. Oh, here we go. 37 seconds, 35 seconds, 34 seconds, 31 seconds, 30 seconds, 29, 28, 27, 26, 25, 24, 23, 22, 19, 18. Look at the nervousness. Look at the nervousness in the market. Look at that. Look at that. Look at that. 10%, 9%, 11%.
They've cut that in half to 2, which basically marks the whole thing to market. Just about holding on now to a 104 handle. There's one question I've got for you, Bob. It's a forecast we haven't talked about. The longer run dot. It is inched up by like that much, from 2.9 to 3. Is there not a bigger realization going on at the committee that needs to come up a whole lot more? Why is this taking so long to draw that conclusion?
Yeah, I think the realization is setting in, and I think having a dissenter on board is going to help drive that conversation. But if you step back and think where 3% is relative to a few years ago, that does seem pretty high. We had negative real Fed funds rates for a long period of time. The very first stop back in 2012 was 4.25%. Now we're right about that 4.25%. Why not just sit there and say, we can get to around 2% inflation.
Yep.
About 1% of a real Fed funds rate is about the right level of pressure. I still think it's going higher.
The chairman talked about a recalibration. We've had 3 meetings, 100 basis points of cuts across 3 meetings. Was that the recalibration? Have we had it now?
I think that's some of it. I think
you think that's only part of it?
Yeah, I think that's only part of it. It just takes a weak labor print over the next month or so. It takes a surprise to the downside in core PCE. One of those things to remind the Fed that this level of rates with a 4 handle in this economy that's come from 0 interest rates is still somewhat restrictive, and there's more work to do.
If you are just joining us, welcome to the program. 10 minutes ago, a 25 basis point reduction from the Federal Reserve, a sprinkle of dissent, but that's not where the headlines are. The headlines are in the summary of economic projections released alongside the statement from the Federal Reserve, where they increased their forecast for GDP for 25. They took down their unemployment rate forecast. They pushed up their forecast for PCE, and they did this with interest rates, projecting rates would drop only to 390, when previously they were looking for 340. So the Federal Reserve essentially, for the median dot, has gone from projecting 4 cuts in 2025 to just 2. Off the back of that, in the bond market, yields are higher, the dollar's stronger, and equities are rolling over. On the S&P 500, we are down by 0.6%. To weigh in on this, Diane Swag of KPMG joins us now. Diane, you've had some time to pore over all of this. Let's start with those projections. Was that in line with what you were looking for?
Actually, it is, and I'm glad to see it. I thought that the Fed was going to, if they were going to do a quarter point, which was already priced into the market, that they had to scale back dramatically, at least by half, their forecast for rate cuts next year, which is what they did. And the disagreement within the committee is exactly what you would expect. There's a lot of debate right now about how close are we actually to neutral. And in fact, the new Cleveland Fed president was one of the ones that said we may be closer than you think. So it's not so surprising that she cast a dissent, even though it's her first meeting. It's also her last meeting.
You see what's happening? Okay. The market wanted 25 basis points cuts. The market got the cuts. And now the market is saying, okay, what is a new story now? What is the next story? And that is what I mean when I'm talking about it's story time. Okay. We're basically now looking to think about what is going to happen next, right? So, are we going to have more rate cuts? And basically, what the Fed is saying is, it looks like inflation is a little bit hot. Unemployment is going to go up, but we're still going to cut rates. So now you're going to have this tug of war back and forth, back and forth, back and forth, because we want more cuts. We want more cuts. At the end of the day, the economy is doing just fine. We only have maybe I think they are projecting 4% of unemployment. Everything is fine, folks. There's no big deal. Okay. The thing is, if you look at the market right now, right, if you take a look at the if you look at the hot Tesla is down, QQ is down, they're all down right now. Okay. What did they expect? Okay, I guess they expected more negative news about the economy and positive news about the inflation, so that we could keep lowering the rates. You know what I mean? So basically, the way you're going to make money in this market, even though we're down in the portfolio, trust me, it's not going to last, because he's going to start talking at around 2:30, right? And as soon as he starts talking, we need to listen, because obviously that's going to impact really what his thinking is. And I guess the market wants to know, so we're done with the rate cuts? I thought we were going to get 4. Now we're only talking about 2. Whoa, big whoops. Now is the time to buy. Now is the time to invest. Now is the time to get funky. Why? Because we still are talking about stories. Fundamentally, we don't have a huge amount of inflation. Fundamentally, we don't have a bad economy. Fundamentally, the tech stock are going to grow. So what you want to be focusing on, you want to be focusing on the tech stocks. You want to be looking for growth. You want to look at undervalued assets. Of course, you don't want to listen too much about the news, because the more you listen to these people, the more you're going to realize, oh my God, this is a bad thing. But This is not a bad thing. This is not a bad thing. This is a good thing. Of course, it would have been better if I guess we had a low economic activity, and they would have liked that better. Maybe I don't think so. Okay, so this really is a good example on what to think and how to learn from the market. The market, believe it or not, if you were thinking about if your story was okay, well, I'm waiting for the more rate cuts. No, that is not the story anymore. The story is how much inflation is going to impact their decision to lower further the rates. Is there something that we don't know? Is the economy overheating? Imagine, right? Not a long too long ago, we were thinking, and you don't hear them anymore. We are in a recession environment. Okay. Because that's great. If you have a recession, then you're in big trouble. People want to hear about that. But now, not only do I not have a recession, but I am now concerned that I'm overheating the economy. Okay. So, meaning that you're overheating the economy, which means you're overheating inflation, which means we got to take it, we have to take it down a notch in terms of lowering rates. Of course, what is not, I mean, we'll see what he says in a few minutes. But of course, we need to worry about what is going on with the tariffs. So there's uncertainty, and always in the market, when there is uncertainty, people sell. Yeah. Remember, the way you made money in the stock market is you need to buy when everybody else is selling, not the other way around. So right now, you should be buying. Of course, you can say, but the market is down. That's the point. But if you look at the fundamental of the market, the fundamental of the market is perfectly fine. I keep saying that the profit is fine. Now, of course, we have to realize that we don't trade in reality. We are trading in numbers that we see that are supposed to represent the reality. We are dealing with what we think this person is going to say, like obviously Fed Powell. We are trading in terms of what is it that's going to happen next, which we don't. At the end of the day, this type of investments, this type of thinking is akin to guessing, being lucky. Okay. Why? Well, as you could see today, we wanted the rate cuts. We got the rate cuts, so we should be up. We were up a week ago. We did a great trade on QQQ a couple of weeks ago, 2 weeks ago, when we saw that we didn't have such a big issue with inflation. Okay. And that we will indeed, get a rate cut. But you are getting a rate cut. You got it today. That's what you wanted, wasn't it? Yeah, but now I want to make sure I get more rate cut. But you are going to get two more. Yeah, but he's talking about whether or not we're having an issue with the fact that there may be some overheating. So we're not going to get four rate cuts. We're going to get two. Maybe there's something going on with inflation again. It's the uncertainty. Really? I mean, inflation has been hitting us all right now already to begin with. Don't forget to subscribe to this channel, by the way. We already know what he's going to do. And what I'm going to do when he starts talking, I'm going to show you the portfolio as he's talking. Okay. So we get a feel as to what is going on with the market. We're gonna listen to him and we're gonna see what he's saying. And this is where, folks, this is a great class right now. There's a course. And you can't get courses like that. Why not? Because it's live. We're going to live listening to see what's happening and see how the market is reacting. The market is this living and breathing creature, okay, that is highly emotional. Okay. Right now, let me show you where we are so you could see how emotional this thing is. This is what's happening in the market right now. Look, my names are all red. GCT, Tesla, QQQ. The only one that's doing great is VMC. By the way, it's been VMC has been look, everything is red right now, as you could see. And we've been killed for a while here. Right? So you could see the situation that we're in right now, where Tesla is -1.6, everybody's red. Okay, mark my words on this. So what does it mean? Look at the news. Magnificent seven stock. Nvidia cuts gain. Tesla reverse from records high at 212. Why? Why are you reversing? Why are you reversing? Let me show this tab instead. Why are you reversing? I continue reading. Magnificent. Tesla versus hold the disparate front of the market, blah, blah, blah. I mean, obviously, the Magnificent 7%, 50%. I mean, this is what's driving the NASDAQ. Okay. If we go to Amazon, Tesla, skid 2% Wednesday, another all time high on Friday, announced price quarter earnings gain. I mean, the company doing fantastic. I mean, I don't know what the big deal is on Tesla. Tesla is doing fantastic. So everyone is doing fine. Everyone is doing fine, and you're getting your rate cuts. You should not be concerned about anything at the end of the day. The thing is now we are concerned about what they're thinking is happening. And this is where the challenge comes in the stock market. Soon we're going to hear from the Fed chair. We're going to see what he has to say. And we're going to realize that. So basically, we are trading off somebody's thoughts, what he's saying. Not only what he's saying, but what we think he means when he says it. I mean, it's an incredible thing. We are creating value out of thin air, literally. We are creating value out of thin air. Why? Because we're not creating anything. Nothing else was created. The Tesla didn't make any more cars in the past 20 minutes. You're gonna get your rate cuts. You are getting your rate cuts. That means that very highly your mortgage cost is gonna go down. Obviously, CD rate is gonna go down, but as the rate is going down, more money is gonna go into stocks. And where do you think it's gonna go? Right? I mean, this is a fantastic opportunity right now. Now, having said all that, I have to say one thing. This is a great opportunity until the end of the year. My only concern is when we start the year in 2025, we're going to see, Trump is going to come in and he's going to say, okay, these are the things that we are going to be doing. And that's going to be a problem because you don't really know what he's going to be doing. Exactly. Tesla goes more entangled with Trump politics, which is okay right now. Show me the money. That's okay because it's benefiting Tesla. He's going to get the regulation ticket. Well, what we think that's what we're talking about, right? He's going to get the regulation for the full driving vehicle so that the robo taxi gets moving. He's going to also they're going to remove all those tax incentives for the other cars, the other electric cars, GM and Ford. So that's great. That's great. But long term, be careful because if He does not get along. Now, of course, you can say, but this is ridiculous. Why are we talking about Trump? Listen, people, we are literally talking about this man that's going to be talking, the Fed chair, right? Based on what this guy is going to say, you're going to see the market move again, maybe in another direction. So trust me when I said that if Trump, for whatever reason, right, for whatever reason, picks a fight, he picks a fight with Elon Musk, you're going to see some huge amount of loss in value. I mean, not right now, not right now. I mean, we still have time. For them to say, I mean, he hasn't come in yet. He hasn't said anything. He needs to sit down in the Oval Office. He needs to take some decision. But he will do it. He will do it. So let's see what the pundits are saying right now, and make fun of them a little bit, because I think it's always good fun to see.
The hiring rate has stabilized a little bit. Job openings have picked up, but are they as concerned about this rise in the unemployment rate as they were during the summer? Second question, I think, is on shelter inflation. We did have this big downdraft in the latest print that went against Chair Powell, saying that it was going to be a very slow progress on this front. How are they just thinking about over the next several months? I think is an important question for them as well.
Matt, there's one big problem I've got with this decision, and it's the words the chairman used in the last news conference. We don't guess, we don't assume, we don't speculate. That inflation forecast, Matt, are we sitting here and really saying that much has changed in 2 months that warrants the upgrade to that inflation forecast of the FOMC without guessing, speculating, or assuming on what policy is going to do?
So our own inflation forecast is 2.6%. That builds in about 20 basis points from tariffs. So, they'd be a little bit more hawkish on the inflation front than we would be. Just going back to 2019, I don't think they're really building in tariff effects explicitly into the forecast as of yet. I do think that is factored into the risk assessments that we see in the back of the SEP, where everybody kind of shifted back towards upside risks to the inflation front. But that should also make you worried to a certain extent. If their baseline is 2.5% without tariffs, it'd be even higher than that with tariffs, which are likely coming. And therefore, they'd probably be taking out even a little bit more of those rate cuts that they were.
Well, hold on. When we say the tariffs are coming, we're assuming that they're coming. Okay. And when you say that tariffs are coming, it's impacting us, but it's also impacting the other guy that needs to get charged. It's going to be, it's going to hit, Canada and Mexico. You really sure that tariffs are coming? Maybe it's just a negotiating techniques.
We're anticipating, which was already leaning in a hawkish direction.
No doubt you'll hear lots of questions about that about 3 minutes' time when this news conference starts. Matt, we'll let you run. Matt Lazzetti of Deutsche Bank. Neil Dutter of Renmac writes in, talked about him a few times already this afternoon. Fed is prejudging policy. That's one view. That's Neil's view.
Yeah, and he's talking about the fact that they're...
See what you just said? The Fed is prejudging policy. That's a story, basically. Is this what's happening? Is this what they're doing? You see how stories get developed in the market? You see how they get confused?
Has been such a huge shift without some sort of massive change in the tone of the data that I think people will disagree with. We have some people who say the data has come in a lot hotter. Nonetheless, they have a lot of things to explain in this press conference.
But Michael, are they speculating? Are they assuming? Are they guessing at the FOMC?
Do you know what? Their inflation forecast just struck me as frustration.
Frustration with what?
With the stickiness of inflation. It should be 1.9 to 2% by now. Look at how the labor market has loosened up. Look at how growth has slowed down. And here we are, still around 2.25 to 2.6%. I don't read anything into it more than that.
So basically, do you think that at this point, this is a Federal Reserve that basically really is just throw it to the dartboard?
They have to be, because they don't.
Well, that's essentially what he's saying, but carry on.
They don't know what. By the way, back in 2009, they would have forecast 2.25 to 2.5, because remember, they had the flexible average inflation targeting. They wanted higher inflation for a period of time, and that's what existed in '95 during the last soft landing. Now, they don't guess.
Colin Horst, let me bring it up with you. It's real simple. Are they on an ex post method that they use for 4 years, or are they actually getting out front and predicting? I don't buy it. Ex post, they got to wait for GDP to crack, for unemployment to get to 5%.
Right now, they have the cover of both, don't they?
Yeah, exactly. I mean, they're just an ex post machine. That's all there is to it.
Bob, Michael, this was fun. It's good to see you,
Yeah.
sir. Almost at the holidays. After this is kind of it for many of you going into year end, for us included. Physically, I've said we'll be here, but sort of psychologically, we'll be somewhere else.
Okay, you keep saying
after we
this.
wrap up this news
So
conference.
you want me to still come in tomorrow? When you're
Okay,
checked
you're
out?
going to be
Yeah,
here.
are you going to be here? Or are you
TK
going
will be somewhat
here?
checked out.
You're actually going to get to go off.
No, TK's not here physically
Yeah.
either, right?
Yeah, exactly.
You're done.
I didn't take a vacation day until the Red Sox were eliminated. Okay, that's my tradition. So that got me to May 10th.
Nice.
And so thank you. So, I'm taking a couple of days off. I'll be here next week to pick up the pieces.
Okay.
Well, the chairman's here right
Here we
now, so
go.
we should probably cross over down to Washington, D.C. and catch up with the chairman of
Here
the
we
Federal
go.
Reserve, Jay Powell, after reducing interest rates by 25 basis points.
Good afternoon. Mike and I remain square. A year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on consumer price index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and
Now you notice, right? Economy is strong. The economy is strong.
projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September.
The unemployment rate has moved up but remains low. That means that it is still very low. We don't have a problem. That also potentially means that then they shouldn't be too afraid of raising rates to hit unemployment.
Employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices.
Maximum employment, that's what I've been saying all along, and stable prices.
To our 2% goal and keeping longer-term inflation expectations well anchored.
So they got to make sure that people adjust with that. They don't want to make sure they kill the inflation so that people have and lose jobs at the same time.
In businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina. Gina Smilek with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut. And I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year. That inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people. The way I would say this is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
Did you know that gamers and tech enthusiasts like you and I have turned their IT career? JobWorks education and training has helped hundreds.
A little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation, September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see on inflation to as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, I want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations